Welcome back to Primary Source China Investment. Peng Guo and I are here with show S5, and we're going to be talking a little bit about China growth in GDP and its effect or not effect on the stock market. It's something that we've covered tangentially before, and in fact, I even wrote an article about this for the China Project about 18 months ago. This is, although at that time I wrote more about shareholder structure of Chinese companies, the regulatory pressure and transparency. This week, we're going to look at some of the hard numbers. For the past 20 years, China's GDP has averaged around 8% annualized growth. Sure, it's largely because in the early 2000s, there was huge numbers, double-digit growth, but the average is about 8%. And it's also been coming off, which means it's been increasing at a decreasing rate. In the last 20 years, China has never produced a negative GDP number on an annualized basis. So every year, China has produced a positive GDP growth, although that GDP growth has been slowing over the last 20 years, as you can see in the chart. Peng Guo, I'm not going to ask you to fact check the data, but does that sort of jive with your thought?
I think, yeah, this is some slow period. So you probably see a lot of the news or worries from the news. But it looks like, and soon it's back, still back to the growth.
Right. So when we map that against the return, and I have the Shanghai Composite here just because the data was easily accessible. So, in the early 2000s, you had huge GDP numbers on an annualized basis. And there will be some objections. Well, China's GDP growth, you can't trust that. Well, over 20 years, I think you can probably trust at least the trend or the aggregate numbers. And you map that against the return of the stock market. And you can see some wild volatility in the returns. You can look at huge growth in 2005, 6, 7, where GDP was growing 11, 12, 14%. And you had similar returns in the stock market. 2006, you had a 130% return. 2007, you had a 96% return, only to turn around in 2008 and drop 65%, turn around 2009 of 79%. But interestingly, GDP was beginning to come off, and it was growing at a slower rate. So you can see all through the 2010s, you had similar volatility every year, down 20, up 3, down 6, up 52, down 9, down 12. So you had GDP growing, but not necessarily any correlation with stock market returns. So the point we're trying to make here is fundamentals. The stock market doesn't trade on fundamentals of the overall economy. I think we've tried to make that point many, many times. And the reason for this is because China's stock market is largely speculative. It is based on individual investor demand. Because there's no 401ks, there's no ESOPs, unlike US market where every month money is going into the market by people's employer or people's savings plans. Is that one of the reasons, Peng Guo, or is there other big reasons why you see
I think
this
there's
divergence?
many reasons. I think it definitely can create a book about that. But
Yeah.
overall, we know like the GDP is about to measure the entire economy output. But the stock market really measure the performance of the public companies. So I think for the China market, firstly, is China starting with the emerging market. So if you compare China emerging market, the Shanghai Composite Index, I believe it's much better than other emerging markets.
Yeah, that's true. We covered that a couple of weeks ago. Yeah, no, that's exactly right. Yeah.
Yeah. Second is U.S. market. Obviously, U.S. can print the dollar. That's nobody can do that. They can spread the cost to the entire country, entire world. In China, the tax, they don't charge a very high tax if you do the short-term trade. But in the United States, that's probably very high tax if you like the watch the stocks. So that is probably the major reason, and not just encourage the long-term investor. I think that should be the second one. And also another major reason in my not my opinion is like the British resort I mentioned before. With the profit, So all those companies invest them, put them in, they try to get a profit. But after deep research, entire world, probably 60 to 80% of the profit came in taken by the US company rather than China company. So they just eat a small piece of pie. Third thing is like the China market, they are more favorable to the IPO, those companies, rather than protect the investors'
Yeah, not this year though,
dividend
but yeah,
return.
yeah.
So that's you have to select like the high dividend at least to give you some kind of the protection.
Yeah, that's another point I wanted to talk about. There's talk that China is a value play right now, and I would argue that the biggest names in China have continuously produced the lion's share of the profit. Also, the big financial companies, the big institutions in China have produced the lion's share of the profit locally, and those companies have been doing quite well for many years. So the idea that China is cheap right now. I just want to put up a chart of the PE ratio from 2001 to 2023. I mean, you can see when those eye-popping numbers on the stock market were coming out, the PE was skyrocketing, and now it's come off a little bit, but it's not low by any stretch of the imagination. Low PE doesn't mean it can't go lower PE. China's stock market doesn't trade based on GDP growth. It doesn't necessarily trade on fundamentals. However, on the stock selection side, industry selection side, sector selection side, you should always be looking for good companies that produce consistent earnings. And that's what we've been talking about here for 2 years.
And also always check our absolute return index. Like recently, our like the healthcare, IT, and defense index, they all move to the uptrend. So only hold the indices in the uptrend. That is our opinion.
No, that's
and also
that's
never forgot China financial behaviors. As long as 1 day or even 3 days up will inspire the entire market to back.
Yeah, that's another
money.
old expression, buy winners and sell losers. I think, China is a perfect example of that. When things go well, people seem to rush in. Although there's been a big push to try to get more institutions invested in China, it is still largely a retail marketplace.
That's right. Yeah.
All right. Well, we're going to leave it there this week with show S5. Thanks for tuning in, and we'll see you next week.
Thank you.